I'm Mariana Bush, and I'm the head of closed-end fund and ETF research at Wells Fargo Advisors. The best ways to, I always think, understanding the exposure that the portfolio is providing is key. Should be the number one question anyone should ask. Typically, the fund sponsors do a very good job with their websites. The fact sheets are 1-2 pages that provide a lot of information about the exposure, which make the risks much more obvious, whether it's a country breakdown or a credit quality breakdown or duration or the assets. That gives you sometimes an idea of liquidity. So going to the fact sheets and the websites is a simple but key element in understanding what kind of risks, what kind of exposures are you getting with this closed-end fund. Once you have identified, or the financial advisor has identified the kind of exposure that the client may be looking for, I think the second question should be, well, what kind of a wrapper, what kind of a package should be the most suitable, the optimal for that client? And here there is no right or wrong answer, because it could be something very plain vanilla with no leverage, something very, very transparent, like an ETF, for example. Or on the other hand, it could be something more sophisticated, like a closed-end fund that would provide regular high cash flow, maybe with some leverage to enhance the distribution rate, maybe less liquidity. So there are some gives and takes. And again, it's not a matter of one is necessarily better than the other one. However, I truly believe that one is a much better fit. A vehicle is a much better fit for a client than another one. So it's understanding these differences and which is the wrapper that should be for that one client, and maybe another one will be the better fit for another client. Sometimes, especially when the market weakens, closed-end funds are not extremely liquid. In fact, in the past, I've compared the liquidity of closed-end funds with that of other heavy yield-focused instruments like MLPs, like REITs, like BDCs, like mortgage REITs, and even to different market caps of stocks. And what I found is I thought that closed-end funds would have the liquidity of small caps. I was wrong. The liquidity is much more alike to that of micro-cap stocks. So for sure, investors have to be very aware and careful about trading closed-end funds. If they don't know what they're doing, the price is just going to drop or increase too much, and they're going to get very poor execution in trading. So investors need to be very aware of that. So because of that, because of this lack of liquidity, when there is market weakness, often the discounts widen substantially. It's very easy for the discounts to widen. And so in a short period of time, the returns could potentially be disappointing. We've seen that. I've been covering this for a couple of decades. So we've seen that. For the opportunistic investors who know this, who've gone through these cycles, they're the ones calling saying, I want to get in now. But for somebody who's not so experienced and probably should not be in a closed-end fund, if they're calling about, oh my goodness, what's happened with this closed-end fund? It's down 10% in just the last couple of weeks or couple of days. Chances are that person should not be owning a closed-end fund. Closed-end funds, again, there can be short-term pain, but long-term, most of them, if they're well run, and especially if one gets in at a good timing, good entry point, whether based on the discount or based on the asset class, the returns can be very satisfying longer term. Closed-end funds are unique compared to a few other of its cousins. They're all 1940 Act investment companies, but closed-end funds are unique, are particular. And there's two features, two characteristics that I think at least two of them that people should understand very well. One of them is leverage. And again, leverage is not good or bad, but it's there. It's used by most of the closed-end funds to enhance the yield. Again, not good or bad, although in a rising market, you will want leverage. In a declining market, leverage is going to make returns go down more. So leverage is something that people need to understand. How does leverage impact the net asset value of the portfolio? How does leverage impact the distribution of the portfolio? Basically, short rates is what you need to pay attention for the distribution. Long rates usually for the net asset impact on the net asset value. And those two will probably color what the discount movement is going to be. So again, leverage is one key feature to make sure that people understand, investors understand about closed-end funds. And the other one is the discount. If somebody doesn't really know too much about closed-end funds, they just assume, okay, fine, there's a discount, but the price is probably going to be very much the same as the NAV. No, not necessarily for those of us who know about closed-end funds. So the discount could narrow, the discount could widen, and that, of course, is going to make the returns potentially be different, sometimes much better, sometimes worse than the NAV returns. Probably the most conservative of investors should not be in closed-end funds because of the additional volatility that they tend to have. It's typically those investors looking for cash flow, and I would specify regular and attractive high cash flow. That's the number one reason most investors look for a closed-end fund. In fact, what location is to real estate, yield is to closed-end funds. So for sure, individuals looking for regular and high cash flow, and individuals that are going to be there have a longer term horizon, that are willing to take those short term pains for the longer term gain.